You're welcome back. We've now been joined by two gentlemen. We have here in the studio the CEO of Cowry Assets Management Limited, Johnson Chukwu, to my immediate left. Good morning. Thank you for coming on the program. And to my far left, we have with us the Head of Development Finance at Heritage Bank, Segun Akanji.
Good morning.
Good morning. Thank you for joining us.
Thank you.
Yes, I'm sure you've listened to the CBN governor, Godwin Emefiele. I'm going to start with Johnson here. What actually struck your mind when you heard him talk about the fact that the CBN will now pay attention to financing the productive sectors of the Nigerian economy?
Well, what I felt is that he was actually spot on what is critical to stimulate the growth of the economy today. Today, we're not talking of high inflationary rates. Mm-hmm. We're not talking of exchange rate devaluation. What we'll be talking of, and which there's general consensus within both the political and the economics classes, that there's need for the central bank to support the growth of the real sector. If you recall, the Minister of Finance about 2 years ago said that they have to work with the central bank to ensure that the central bank have a regime of interest rate that will support the private sector. That the government needs to encourage the private sector by making funds available to them at affordable rates. So there's a general consensus, and I think that's what the CBN governor has considered as very pivotal to the growth of the economy. So I was quite pleased with the fact that he has chosen that as his focal point to drive down interest rates so as to encourage the real sector of the economy to begin to blossom, to grow. We're talking about 510 billion GDP, but we also know that we have more than 23.7% unemployment rate. And you can't talk of growth in your GDP. And that's why if you look at even the World Economic Forum, they were talking about inclusive growth. How can you have inclusive growth if you do not have access to funding? I think that's basically what must have informed the decision to focus primarily.
Okay, we'll come back to the issues. That's the nitty-gritty of the issues raised. Let me get to hear from Segun. Segun, what came to you? What were you thinking about while you were listening to the CBN governor?
Well, the first thing that I would want to mention is the fact that while listening to that, an economy of this size, which is now the biggest in Africa by GDP, my first concern is how do we make FDI permanent? Because the FDIs we've had flowing into the country to support development basically are transitory investment. So most of them invest in light securities, buy the T-bills, do the equities, and such likes, and find a way to exit. And even those that seem to sit in for a while, I was reading this morning, Mudabala was trying to say they want to exit Nigerian telecom industry. How do you make FDIs permanent? That is something that you need to work out. Reduce the massive outflow, because this determines the pattern of Nigerian economy. If you see the moment dollars start to go up, it's because Naira starts to go up. It's because investors are bringing in money to invest. And once they start to push out money, and that seems to be very, very speedy. Before you rest, another cycle of upbeat. Before you rest, another cycle. So you need to consistently defend. And that's why you find in the statement, you need to still defend the Naira. You can't leave it to the forces that drives the economy, the basic force of demand and supply. And when you can't have that grip, allow an economy to run, though you have to manage, but allow some independence. Once you can't achieve that because of that high demand, because some people bring in money and they take it out easily, gives you concern.
I want to ask you this question. The short lifespan of FDIs, I think that's what you're trying to say. Although Emefiele did not really talk about that, but could you be that we are in a way responsible for that? Because by not putting our own house in order, by not having to invest where we should invest in, and waiting for foreigners to bring in the monies before we can record any level of growth in the economy.
My concern when I listened to the speech was that if you're going to do a lot in terms of real sector development, you need a lot of investment from outside here. We've seen it over and over. Most of the development we've had are funding. You want to talk about lowering interest rates. You want to talk about providing an enabling environment. You want to make investors come. You need to open the door for FDIs. But not just open the door for them. Create a platform that allows them to stay longer than they stay now. And then let them invest in your real sector. That's what drives an economy. You can do the much you can do with your own resources. But once you don't have access to that consistently, look at we talk about South Africa and Africa all the time. You don't take money to South Africa and if you take it out just like that. Most of the monies go in there, they fund development for quite a while before you can actually take them out. In Nigeria, the money flies in and out.
Seems we don't have any form of structure to keep the money in place.
So you don't have it, and you can't talk about a lot of employment generation. If you saw what happened in the Obasanjo era, a lot of this money came in, they sat for a while. So we could see development in the telecoms, oil sector, all across, banking industry got some money in. So employment was massively created. But now we're doubling our unemployment rate from the time Obasanjo was there, when we had a lot of massive inflow that sat for a while. Now we've doubled that. Now, in terms of unemployment, we are actually approaching 30% of unemployment from 15%.
Okay.
So these are the concerns about job creation.
All right. Well, I'm going to get back to you, Segun. Let me listen to Johnson. Now, the CBN governor mentioned that some key areas that he would want is tenure to concentrate on while he is in office. And he talked about MSMEs, we had agriculture, we have power. Now, these are sectors that we've always paid attention to. What do you think the central bank should be doing this time around, different from what we had previous administrations, do to change the economy?
Well, if you look at the approach of the new CBN governor, what he did say is that he's going to drive down interest rates. He's going to gradually drive down interest rates. There are two things that the previous governor did, one of which was use the instrumentality of development finance to stimulate specific sectors of the economy. There were specific funds that were made available to the likes of the textile industry, the medium and scale enterprises, that were specific to, there was a fund set aside for the agricultural sector. So, but those funds were available at rates that were sub-market rates. They were loans that were granted to those sectors were given to them at below commercial market rate. And that was a way of stimulating those sectors. But the current CBN governor says he's going to drive down, on the average, the interest rates. And what that means is that the sectors, not just those sectors he has mentioned, any sector that is economically viable should be able to access funds. You see, the challenge of using development finance to stimulate sectors of the economy is that it leads to suboptimal allocation of resources. Because what you find out that resources go to those sectors that are favored, and those sectors, because they are favored, they tend to generate returns that are suboptimal to the economy. But when you have a regime of interest rates that is appealing or that is conducive to the growing private sector, then only those businesses that are economically viable will access the funds. Unlike where you have...
We didn't have it in the previous administration.
See, that's what I said. What the previous administration did was they set aside specific funds for specific sectors of the economy to encourage certain sectors of the economy. Like I did mention, there was one fund set aside for the small and medium scale enterprise. There was fund set aside for the agricultural sector. There was one fund set aside for the textile industry. So what happened was funds were made available to those sectors at rates that were below the market rate. That was a way of subsidizing productive activities in those sectors. But the challenge you have is that because such funds are limited, you find out that decisions to give the funds to specific borrower may not be optimal. It might have to do with who you know. Your ability to access those funds might not be commercially driven. But when you generally drive down interest rates, it simply means that any business proposal that is bankable, that meets the return threshold, can access funds from any of the banks. If you recall what happened in the case of for instance, the agricultural credit scheme, not every bank was shortlisted or included to provide those loans. So it's meant that if you have a relationship with any particular bank, you would not, and that bank is not in that scheme, you will not be able to access the agricultural credit scheme through that bank. And that means you have to move to the other bank that has that. It simply means, in as much as it's necessary sometimes to use such instruments to stimulate certain sectors of the economy, but the challenge you have is that it is not universal. It does not give even playground, playfield to every market business operator to seek for funding from the banking system. But what the CBN governor wants to do is to drive down interest rates so that interest rates are at such levels that viable businesses can access funds and be able to afford that interest rate and still meet their return threshold.
All right, Segun, you work in the bank, and I would just want you to tell us what has been your experience like when we want to fund bankable projects, and like he was trying to explain, perhaps a bank aid wasn't allowed to, disburse such funds. What has been the experience like, and how was it handled?
Well, the key challenge you often have is the readiness of customers first, in terms of being able to provide viability for their business. It gives you concern. So you start from that, and then once you're able to cross that, you start to now queue up to get that money for them. So most of the time, what you probably find yourself doing where you find that business good is to provide a bridge, which again brings you back to the concern about interest rate. But some customers will say, well, I don't mind, once you can get that funding for me, then I would make do with what you give me now.
Regardless of the interest rate?
Yes, because, when, for example, you have somebody that is trying to do, let's say, a sesame seed or plantation, and he has a contract of a buyer, he wants to be on speed to deliver that product to the buyer with such good domiciliation, maybe FX side of the benefit. So you want to take that kind of transaction because there is domiciliation of proceeds from the buyer that is credible, which may be long-term. So the customer, first of all, wants to be able to establish its business as a credible partner to his contractor. So he won't mind, first and foremost. Thereafter, if the window opens and you're able to secure that funding, he's willing to go ahead with you. So, but like I was saying, it's how to liberalize that market, because there is so much subsidy can do. It gets to a point you cannot consistently subsidize.
And how do you liberalize the market?
Well, what you need to do, like I said before, is how do you make investors sit in your country, put money in, see their returns, and let the money stay for a while before they take them out. If you go to, at least we always point to developed markets. Even use African countries, like we said, South Africa still, even though it's difficult to put them side by side. But again, there was a time South Africa was not as attractive. The government provided an attractive and enabling system. For example, if you go to South Africa, you'll find what they call the BEE, the Black Empowerment kind of financing program, which provided the black people a liberalized market to access funding. Still competitive. You still need to meet certain criteria to get it. It's just that funding is for that sector, and every bank could partner with the government under that product. So it's not just about interest rate cuts. You need to provide much more than interest rate cuts.
Now, in other words, I just want to ask you, before I move on to Johnson, can only the monetary policy achieve that objective of attracting FDIs and keeping them for a while at least? Do we combine the fiscal policies as well to be able to get the results that we want?
Exactly, you need to, because if you focus on monetary policy and you leave fiscal policy, it's a cyclical thing. Once if you tighten the nozzle here, it will come to the other side. So it's basically the same. You need to do whatever you are doing on this side must complement whatever has been done on the fiscal side. If government is spending excessively through fiscal policy and not doing what it's supposed to do in terms of clear economic platform and programs, and then the central bank is trying to say, I'm holding on inflation, I'm holding on interest rate, I'm holding on exchange rate, it's going to bust. So it's clear planning on both sides that will deliver what gives comfort. For example, if you don't take care of securities, if the security of investor is not guaranteed. The security of investment is not guaranteed. The security of the people living in the country is not guaranteed. You can't bring money. Even locally, people will start shifting to environment, even within Nigeria. Everyone will start shifting to an environment within the same country that they consider safe. Labor will move. Agriculture will move. And just by that single act, you will see that if you look at agricultural production in the north, in those areas like Borno State, which would have been a very good place for agriculture, look at some part of Bauchi like that. Wherever crisis flows to, people start to move. They can't stay on their farm. Like Jos, they can't plant. They can't have the comfort to nurture any agricultural produce because they can't sleep. They can't rest. They are trying to be secure. So you see a migratory population trying to find security. And once they move, there is no production. They all look for food to eat. And where you are not producing, then before you know it, you see spikes in the cost of food.
Okay, Johnson.